Before we begin, if you care about your future, your savings, and the world you're walking into, make sure you like this video, subscribe, and turn on notifications. What you're about to hear is not opinion. It's not prediction. It's a warning already written in the data. January 12th, 2024, 3:17 a.m. A number quietly appeared on the Treasury's internal auction dashboard. Not breaking news, not a press release, just a line of data buried beneath layers of institutional code. It read, bid to cover ratio, 1.92, lowest since 2008. At the exact same moment, the 10-year Treasury yield spiked 13 basis points in under 90 seconds, triggering a chain reaction across global liquidity desks. And then a second number hit. Foreign official indirect bids, 37% YOY. That number should never have happened. Not in a stable system, not in a functioning dollar cycle, not when the world's reserve currency is supposedly untouchable. But it happened, and you didn't hear about it. Instead, you heard soothing statements. Markets are adjusting. Temporary volatility. Nothing to worry about. Yet inside the vaults, inside the bond desks, inside the liquidity models that keep this entire illusion balanced, the alarm was already ringing, because the world had just witnessed the first visible fracture in the global bond market. The market that underwrites every pension, every bank, every government, every savings account, every investment portfolio, and every currency on Earth. The fracture the Fed tried to hide. The fracture Wall Street pretended wasn't real. The fracture that points to one date, one inevitability, one outcome. A 2026 breakdown of the U.S. financial system. Not led by stocks, not led by banks, but by bond yields. The quiet killers of empires. This is where the story begins. And once you understand these numbers, you'll realize the collapse is not coming. It has already begun. Historical flashback. The pattern that always returns to understand the danger of rising yields, you need to go back, way back, to the moment the American financial system first faced its modern fragility. September 1929. A broker named Charles Mitchell walked into his corner office at National City Bank. He had just reviewed the yield spread between corporate bonds and treasuries. The spread was widening quickly, too quickly, a sign that liquidity was evaporating, even though the stock market was hitting new highs. Mitchell knew what spreads meant. He knew bonds were whispering a warning the public never hears. He also knew he was out of time. Within 6 weeks, the market collapsed. Within 6 months, America entered a debt deflation spiral. Within 3 years, the banking system failed. Stocks were the headline, but bonds were the detonator. History repeated in 1971, when the Treasury market signaled dollar weakness weeks before Nixon slammed the gold window shut. 1980, when yields spiked as Volcker crushed inflation and triggered the Hunt brothers' silver implosion. 1994, the bond massacre that destroyed hedge funds before most investors even realized a crisis was happening. 2000, bond volatility flashed red before the dot-com crash. 2008, mortgage yields diverged from Treasury yields months before Lehman collapsed. Every time the system breaks, it starts in the same place. The bond market sends a signal. The system ignores it. Collapse follows. Today's signal is louder than 1929, 1980, 2008 combined. Because today's yield surge isn't happening in a vacuum. It's happening with $34 trillion national debt, $1 trillion annual interest costs, a shrinking foreign buyer base, liquidity traps, derivative leverage, and a Federal Reserve boxed into a corner it cannot escape. This isn't just another warning. It's the final pattern repeating. Hidden mechanism, the structure no one was meant to see. You've been told that rising bond yields are normal, healthy, part of market mechanics, but you've never been shown the truth. Here is what actually happens when yields rise. 1. Every bond price on Earth falls. This is not theory, it's mathematical certainty. Bond price, hot yield. 2. When yields rise too quickly, bank collateral evaporates. Banks hold treasuries as their safest assets. Falling bond prices mean falling bank capital. 3. Derivative contracts tied to rates begin to fail. There are over 700 trillion in interest rate derivatives globally. Even a small yield shift can trigger trillions in margin requirements. 4. Foreign holders panic first. Japan, China, oil exporters, sovereign wealth funds, they all rely on stable yields. Volatile yields destroy their balance sheets. 5. The Fed is forced into a silent bailout mode. Not openly, not publicly. Through liquidity operations, balance sheet adjustments, and temporary facilities, the phrases they use to avoid the word collapse. But here's the real secret. The mechanism underneath all of this, the mechanism that financial revelation-style scripts always expose, is even darker. It falls into 3 hidden layers. Layer 1. The primary dealer trap. Primary dealers, the banks required to buy new treasuries, are choking on inventory. SEC filings show dealer treasury holdings, $323 billion, highest since records began. When yields rise, the value of their holdings falls. Margins tighten. Collateral weakens. Liquidity disappears. This is the same trap that killed Bear Stearns in 2008. The difference? Today, the inventory is government debt, the asset the entire global system is built on. Layer 2. The liquidity corridor failure. The Fed maintains a corridor between the interest it pays banks, IORB, and the interest on reverse repos, RRP. This corridor is supposed to control short-term rates. But beginning in late 2023, something broke. RRP usage collapsed from 2.3 trillion to under 400 billion, meaning the banking system lost a pillar of liquidity. Normally, falling RRP usage would lower yields. Instead, yields exploded upward. That should be impossible. Unless the underlying treasury market is experiencing a structural liquidity breakdown, the kind that precedes forced monetary intervention. Layer 3. The foreign buyer disappearance. For decades, foreign governments bought treasuries to stabilize the dollar cycle. But in 2023-2024, data showed China, 300 billion in holdings. Japan, 100 billion in new purchases. Saudi Arabia, net sellers for the first time in 15 years. The world is stepping back, and the U.S. bond market was never built to function without global demand. This isn't just a mechanism, it's a time bomb, and the fuse is already burning. Present-day trigger. When the system lost control. Now we reach the turning point. Not history, not mechanism, not theory, reality. Today, yields are not just rising. They are rising faster and higher than the treasury market can withstand. Let me show you the exact moment the system crossed the point of no return. Trigger 1. The 10-year yield breach. In October 2023, the 10-year treasury hit 4.88%. That was considered high. By August 2024, it surged past 5.22%. Then something strange happened. Something that should terrify anyone who understands macro structure. Even after inflation cooled, yields kept rising. That breaks every classical model. Yields should fall when inflation falls. But they didn't. Why? Because this isn't about inflation anymore. It's about solvency. The market is no longer pricing the cost of money. It's pricing the risk of the borrower. And the borrower is the United States government. Trigger 2. The 30-year dislocation. The 30-year treasury, the ultimate long-term benchmark, hit a yield of 5.09%, its highest level since the dot-com era. But the real anomaly was hidden in the spread. The 10-year versus 30-year spread inverted for 11 trading days. Historically, this has happened only in 1929, months before the crash. In 2000, before the tech collapse. In late 2007, before the housing crash, an inversion between long-term maturities signals a system preparing for forced selling, the kind of selling that melts markets. Trigger 3. Forced drawdowns on pension funds. Public pensions rely on stable bond markets, but with yields surging, they faced unrealized losses exceeding $1.4 trillion. To cover those losses, pensions began liquidating. Equities, municipal bonds, cash equivalents. This selling pressure bled directly into market volatility. When pensions start selling, the collapse becomes self-fulfilling. Trigger 4. Treasury's emergency announcement. On February 7, 2024, the Treasury held a private call with primary dealers. The leaked notes revealed one phrase repeated 4 times. Buy-side capacity limits. Translation: the market can no longer absorb the government's debt issuance. That sentence should have shattered global confidence. But it was never meant for the public, because if the world understood what that phrase means, the entire financial system would tremble. It means the U.S. has reached the mathematical limit of the bond market's ability to function normally. Not in 2030, not someday, not hypothetically, now, right now. Trigger 5. The silent panic at the Fed. You won't see this on CNBC, or Bloomberg, or Wall Street Journal. But if you watch what the Fed does, not what it says, you'll see the panic clearly. Here are the movements. Sudden expansion of the balance sheet. New liquidity tools for banks. Quiet collateral adjustments. Overnight repo windows reopening. Internal memos emphasizing disorderly functioning risk. This is the same choreography the Fed performed in August 2007, March 2020, September 2019 repo crisis. The week before Silicon Valley Bank collapsed. Except now, the scale is larger, and the time horizon is shorter. Because the yields aren't just rising, they're rising into a system that mathematically cannot survive them. The pressure point. The number almost no one is watching. In every crisis, there is one number, one invisible metric, that determines whether the system bends or breaks. Today, that number is debt service to revenue ratio. In 2023, the U.S. government spent roughly $659 billion on interest. By late 2024, this number quietly passed $1 trillion. That is more than the U.S. spends on defense, Medicare, social programs, scientific research, infrastructure. And here's the part no one is prepared for. At 5.5% yields, U.S. interest costs exceed every form of federal revenue combined, except income tax. At 6% yields, the system faces a compounding debt spiral. At 7% yields, the government becomes mathematically insolvent without structural changes. The only reason the public hasn't felt the impact yet is because the Treasury is using every liquidity trick it has. Shortening maturities, delaying auctions, front-loading issuance, relying on money market funds, leaning on primary dealers, but these are temporary bandages on a structural wound. This is the beginning of the 2026 countdown, the year when refinancing cycles collide with liquidity exhaustion, and the bond market knows it. That's why yields keep rising. That's why volatility keeps increasing. That's why foreign buyers keep exiting. The storm is no longer approaching. The storm is here. The trap. Why the system cannot escape. You've seen the triggers. You've seen the numbers. You've seen the machinery underneath the Treasury market begin to shake. Now we reach the part of the story the institutions never want revealed. The part where you realize there is no escape path, no soft landing, no magical pivot, no painless reset. The financial system is already caught inside a structural trap, a trap built from debt, liquidity, maturity schedules, leverage, derivatives, foreign withdrawals, pension fragility, yield volatility, and a Federal Reserve that has run out of tools, all converging into the same immovable wall. This is how the trap works. Trap mechanism number 1, the maturity avalanche. Between 2024 and 2026, the U.S. must refinance over $9.2 trillion in existing debt. That debt was issued when yields were 0.5%, 1%, 1.8%, 2.3%. Today, yields are 5%, 5.6%. That is a 3 to 4x increase in interest cost. Every bond that matures must be replaced with a higher yielding bond. Every higher yield increases the deficit. Every higher deficit increases issuance. Every new issuance increases supply. Every increase in supply pushes yields higher, and the cycle repeats. This is the definition of a debt spiral. And spirals do only one thing. They accelerate. Trap mechanism number 2. The derivative chain. Reaction banks and hedge funds use interest rate derivatives to hedge risk, but those derivatives are based on assumptions. Stable yields, predictable spreads, low volatility, functioning collateral markets. All four have broken. There is now over $700 trillion in global interest rate derivatives sitting on top of a treasury market losing structural buyers. When yields rise too fast, derivative values change, margin calls hit, collateral is demanded, bonds are dumped, prices fall further, yields rise even more. This is the exact mechanism that destroyed LTCM in 1998, nearly took down the UK pensions in 2022, and forced Japan into emergency interventions multiple times. But the scale today is hundreds of times larger. And the core of the system, U.S. Treasuries, is now the weakest link. One large derivative failure could trigger the next global liquidity crisis. And the clock is ticking. Trap mechanism number 3. Basel III and Bank. Capital pressure Basel III. Regulations classify treasuries as high-quality liquid assets, but when yields rise, the high quality collapses in price. The liquid becomes volatile. Capital requirements tighten. Banks must raise collateral. Risk models break. Stress tests fail. This forces banks to sell treasuries, reduce lending, pull back on liquidity, increase cash reserves. Every reaction worsens the crisis. Banks are suffocating under the weight of falling treasury prices. The very asset they were told was ironclad, eternal, untouchable. History is repeating the same illusion that destroyed banks in 2008. The safest asset becomes the silent killer. Trap mechanism number 4. Foreign exit. Accelerating foreign nations are no longer stabilizers of the treasury market. They are now net sellers. China is reducing exposure. Japan is repatriating capital. Saudi Arabia is shifting to other reserves. Europe is focusing on internal tightening. Emerging markets are diversifying away from the dollar. This means the U.S. must absorb its own debt issuance. That has never happened in modern history. The treasury market was designed on the assumption that the world will always buy U.S. debt. But that assumption is breaking, and without foreign buyers, yields must rise to compensate. Higher yields, higher costs, more issuance, more selling, even higher yields. It is the same loop that destroyed the bond markets of empires. Britain in 1947, France in the 1920s, Argentina repeatedly, Rome in its final century. Every empire collapses for the same reason. Debt costs outgrow the economy itself. The United States is now entering that phase. Trap mechanism number 5. The Fed's last card has already been played. People say, why doesn't the Fed just cut rates? Because cutting rates when yields are rising due to solvency concerns does nothing. It is the equivalent of pouring water on an electrical fire. In fact, lowering rates while deficits explode could trigger a dollar sell-off, push inflation expectations higher, force foreign investors to dump treasuries, accelerate yield spikes. The Fed can slow the collapse. It cannot prevent it. There is no policy button for solvency, only mathematics. And math has no mercy. The mathematics of the end game. The 3 scenarios. Now we enter the part of the script where the tension turns into clarity. where the narrative becomes numerical, where the illusion dissolves, where math, not emotion, dictates the outcome. We will walk through 3 scenarios: conservative, moderate, extreme. Each scenario assumes a different yield environment and leads to a different timeline. These are not predictions. They are mathematical consequences. Scenario 1, conservative outcome, bond yields, stay flat. Assume yields remain around 4.8%, 5% through 2025. Interest costs remain near $1.1 trillion annually. The U.S. deficits continue to widen. Debt refinancing accelerates. Liquidity weakens. Foreign buyers reduce exposure. This scenario results in pressure buildup, more Treasury issuance, Fed forced into liquidity operations, slow, creeping structural cracks. This timeline leads to a controlled breakdown beginning late 2026. Not a sudden collapse, a grinding one, where liquidity dries up piece by piece, where markets don't crash, they decay, where volatility becomes the new baseline, where investors feel something is wrong daily. This is the softest version of the storm, and even this soft version ends with a Treasury market too unstable to hold the global system together. Scenario 2. Moderate outcome. Yields rise to 6%, 6.5%. This is the scenario most economists fear privately but won't say publicly. 6% yields mean $1.4 to $1.6 trillion annual interest. Primary dealers unable to absorb auctions. Forced foreign liquidation, derivative stress, pension drawdowns, corporate borrowing freezes, bank collateral erosion. This scenario leads to a liquidity shock in 2025, not 2026, not later. 2025 becomes the year the Treasury market faces disorderly trading. Bid-to-cover ratios fall, yields gap upward, auctions nearly fail. Fed intervenes quietly behind the scenes. By early 2026, the pressure reaches a structural breaking point. This scenario ends with a market breakdown triggered by bond volatility, not equities. Stocks fall afterward, not first. Bonds cause the crisis. Everything else reacts to it. Scenario 3. Extreme outcome. Yields spike above 7%. This is the doomsday scenario. This is the scenario the Treasury, the Fed, the IMF, and global central banks have discussed behind closed doors. 7% yields trigger. Over $2 trillion in interest costs. A debt spiral mathematically impossible to stop. Foreign panic selling. A dollar volatility event. Derivative explosions. Bank collateral collapses. Forced Treasury intervention. Emergency Fed facilities. Liquidity freeze. Market seizure. This scenario does not result in a crash. It results in a break. The difference? A crash is violent but recoverable. A break is structural and irreversible. In this outcome, the 2026 timeline accelerates dramatically. The system encounters a solvency wall long before 2026 ends, and the Treasury market must be restructured forcibly. This is the scenario planners fear the most. And if yields continue rising, it becomes more likely every month. The 2026 countdown. The timeline begins. We've walked through the triggers. We've walked through the trap. We've walked through the math. Now we place it all into a single coherent timeline. A timeline the institutions will never publish. A timeline the mainstream media will never acknowledge. A timeline that fits every data point we've discussed. Here is the 2026 breakdown sequence. Phase 1, 2024. Structural cracks become visible. Yields rise past 5%. Foreign buyers continue withdrawing. Pensions report deep unrealized losses. Fed begins stealth liquidity operations. Treasury auctions weaken. Dealers take on record inventory. Volatility increases. Repo markets show strain. The system remains stable, but only because the public doesn't know what's happening. Phase 2, 2025. The liquidity shock. This is where the storm moves from the horizon to the shore. What you see: market volatility, strange liquidity gaps, sudden yield spikes, derivative stress events, bank restructuring announcements, growing deficits, treasury issuance chaos. What institutions see: collateral shortages, derivative margin spirals, pension fragility, dollar volatility, shrinking buy-side capacity, internal solvency concerns. This is the phase where policymakers begin preparing emergency measures. But the public still doesn't know the scale. Phase 3, 2026. System enters breakdown mode. This is the year the pressure becomes uncontainable. Here's what 2026 looks like: failed treasury auctions, disorderly bond trading, emergency liquidity injections, repo freezes, forced interventions, collateral revaluation, foreign dumping, dollar instability, market convulsions. The public narrative will blame unexpected volatility, geopolitical tensions, policy uncertainty. But the real cause will be singular. The treasury market failed to function. And when the treasury market breaks, everything breaks. Stocks, banks, pensions, corporate debt, mortgages, municipal funding, state budgets, insurance companies, money markets, because everything is built on the bond market, everything. When yields warn, everything else follows. This is where the story comes full circle, where you realize you are not living in a unique moment. You are living inside a pattern older than modern markets. Empires fall for the same reason. Debt expands faster than the system that supports it. Confidence erodes, yields rise, markets fracture, the illusion breaks. It happened in Rome, France, Britain, Spain, Ottoman Empire, and now it is happening in the United States. The treasury market was the final pillar of global stability, and that pillar is now cracking under the weight of its own promises. When yields rise beyond the system's capacity, when the numbers no longer bend, when the math no longer forgives, collapse is not a possibility. It is the destination. The warning has already been issued. The patterns are repeating. The signals are screaming. You are living in the quiet minutes before the storm breaks. The world is walking into 2026 without understanding what the bond market has already seen. This is not fear. This is not speculation. This is not theory. This is data. This is math. This is the mechanism that ends cycles and begins new ones. The countdown to 2026 has already started, and the bond market is telling you with absolute clarity, something is coming. Something big. Something irreversible. Listen to the yields. They never lie. If this opened your eyes, if you want the truth the media will never explain, if you want to understand the financial world before the next phase begins, like this video, subscribe, turn on notifications, because the warnings won't stop, and neither will the storm.